I grew my investment portfolio by 70% in just 2 years simply by investing consistently. Now, my goal has been to achieve financial freedom through investing, and I didn't start with thousands of pounds or any complicated strategy, just small, consistent steps that actually worked. Most people don't invest in the stock market because they feel it is too complicated or too risky. So instead, they put their money in a savings account, thinking that's the safest way to protect their money. Now, if you're here, I'm sure you already understand the importance of investing and you're looking for a way to start. So in this video, I'm going to give you a step-by-step beginner's guide on how you can start as soon as possible. So now let's start with what is investing. Now, investing simply means putting your money into something that can grow over time. Instead of just saving in a bank account, you're using your money to make more money through stocks, property, or other assets. Now, keeping your money in a savings account barely grows. It just sits there. Instead, you need to make your money work for you and generate a passive income, which is also great for retirement. Now, before you start investing, it's important for you to open the right account. Now, think of it like opening a special wallet for your investments. There are a few types of accounts that you can open in UK, and I'll break it down for you. Now, the first account that you can open is called a Stocks and Shares ISA account. This account is great because you can invest up to £20,000 each year, and any profits you make, whether from capital gains or dividends, are completely tax-free. The second account that you can open is called a pension SIP account. And this is great if you want to invest long term for your retirement, and it's also got some tax benefits attached to it. The next type of account is for kids, and it's called a junior ISA account. So now if you want to start investing for your child, you can open a junior ISA account and you can hand over the account to your child when they turn 18. So if you're just starting out, a Stocks and Shares ISA account is the best type of account to start. For the purposes of this video, I just want to point out that I am not a financial advisor, and this content is merely for entertainment purposes. So if you are serious about investing, please consult with a financial advisor. Now, what kind of assets can we invest in? You can invest in stocks or bonds, and I'm going to break it down for you. Bonds are loans that investors make to a company or a government in return for periodic interest payments and the repayment of the principal amount at maturity. So it's like lending your money to a company or to the government, and then they pay you interest in return. It's usually less risky than stocks, but it also grows slower than stock. On the other hand, stocks are also known as shares, and they represent fractional ownership in a company, allowing investors to become part owners and potentially benefit from the company's profits and growth. So if you buy one share of Apple, that means you own a tiny bit of Apple. If the company does well, your stock becomes more valuable, but if the company doesn't do well, your stock becomes less valuable. Now, instead of researching a stock and investing all your money into one stock, which can be really risky because if anything happens, as you know, your money goes down, you can invest in a group of stocks, and this is called a fund. Now, a fund is like a bundle of stocks all grouped together. So instead of investing in one stock, you're investing in a lot of stocks at once. Now, how do we choose a good fund? The first factor to look out for is a fund with low fees, and that is generally below 0.5%. So an index fund with an expense ratio of under 0.5% or even better, under 0.2% is ideal. You essentially want to keep more of the profits in your pocket and not giving it all out to fund managers. So that's why it's really important to look for a fund that has low cost fees. Secondly, it's better to pick funds that mirror indexes like S&P 500, NASDAQ, and FTSE 100. And this is because these indexes have experienced a great performance over time. These funds give you exposure to strong top companies with just one click. So it's a lot more safer to invest in them. Next, it's best to choose an index fund instead of a managed fund. And that's because actively managed funds are run by people who think that they can beat the market, but they don't actually beat the market. Plus, they charge you higher fees. So here are the reasons why index funds are much better for beginners. 1, you pay low fees, so you're able to save more and earn more. 2, because of the diversification. Now your money is spread across hundreds of companies, which helps you diversify your risks. Thirdly, it's simple. There's no need to pick individual stocks or time the market. And lastly, it can be done hands off. So it's a set it and forget it strategy and great for long-term growth. And if you don't really want to monitor the market full time. Now, studies show that index funds have consistently outperformed actively managed funds over the long term. Plus, they have lower fees than actively managed funds. So let's walk through an investment platform and how to pick funds to invest in. Now, there are different platforms that you can use to open an investment account. Vanguard is one of the popular platforms in the UK, but there are others like Trading 212 and Interactive Brokers, which I currently use as well. But let's go through Vanguard and explore how you can easily access and invest in their funds. So you can open an account on Vanguard in 3 simple steps, and they offer different types of accounts to choose from. The first is a stocks and shares ISA account, which can be either self-managed or managed for you by Vanguard. Next is a personal pension account, which can also be managed by you or by Vanguard. And then there's the junior ISA account and a standard general account, which you can open but has no tax benefits. Now, to explore the funds they offer, click on our full list of funds. On this page, you can filter by country. So if you only want to view funds in the US, simply tick the US checkbox to see all the funds in that region. You can also filter by risk level, with 1 being the least risky and 7 being the most risky. There are also options to filter by fund type, so you can choose between actively managed or index funds, and also options to choose whether you want your dividends reinvested or paid out to you. Now, you can either choose from Vanguard's ready-made portfolios, which are already built for you, or you can build your own portfolio. The ready-made portfolios clearly show the composition of each fund, for example, 80% bonds and 20% shares. They also display the risk level and the number of assets in each fund. And this would help you understand exactly what you are investing in and make better decisions based on your risk appetite. Now, on the other hand, if you want to build your own portfolio, you can filter by these asset classes. For example, you can click this checkbox to view ETFs only, or you can click the equities checkbox to view stock-only funds. You can then filter by region, and again, let's click on US checkbox to view assets from US. And here you will see they've got different bonds, ETFs, and equities to choose from. But for the purposes of this tutorial, I am only interested in the S&P 500 fund, which mirrors the index. So for more information, I'm going to click on full fund details. You will now see the option to select either accumulation, and that's if you want to reinvest dividends to grow your account, which I personally recommend, or income if you prefer to receive dividend payouts. The fund page also shows the current market price, the number of stocks, and the ongoing chart. So next, I'm going to scroll down to view the past performance. And as you can see, this fund closely mirrors the performance of the S&P 500 index. Also, in this section, it shows you the past performance of this fund based on if you invested a lump sum of $10,000 in May 2019, which would have grown to $22,015 by March 2025. That's a 120% increase just by investing and letting your money grow. And that, my friends, is the power of investing, letting your money work for you over time. The problem that I see most people have when investing is consistency. Now, how do we become consistent? It's simply to just automate your savings. And that's when you get paid or on payday, you can set up an automation or a standing order or a direct debit from your current account or your pay account into your investment account. And that would automatically leave your account before you even start spending or using your current account for expenses. That way, it ensures that you're automatically transferring some money from your current account into your investment account. I like to use the 50-30-20 budgeting rule to ensure that I am allocating my money wisely. So 50% of my income goes to my needs. So needs are like important expenses. 30% of my income goes to my wants, which are like non-essential expenses like eating out or shopping. And then 20% of my income is automatically transferred into my investment account. And this allows me to consistently put my savings into my investment account without even thinking about it. Before you leave, I want to share some important investment tips. The first tip is to build an emergency fund. Before investing, make sure you have saved up to 3 months emergency fund. And this is because if there's an emergency and you need cash, you won't have to sell your investments at a loss. Secondly, pay off any high interest debts. Credit card debts charge crazy interest like 20% or more. Even if your investment grows by 8% or more, you're still losing money if you're paying high debt fees. So clear that first. The third tip is to stay consistent. Just set it and forget it. Even if you put in £50 a month, automate it by setting a standing order or a direct debit into your investment account and just forget it. Investing isn't about timing the market, it's about staying in the market. That's all about investing. Now, if this video has helped boost your confidence to start investing today, don't forget to give it a like and subscribe to my channel. If you've got any questions around investing, drop a comment down below or send me an email and I'll be more than happy to respond to your questions. But until then, have a lovely day and I hope to see you in my next video.